So welcome everyone to a rather special edition of Strength in the Numbers. We've got two former mentors from the show, Rob Trippe and Rubin on the line. And the reason why I got Rob and Lance on the line today was because they recently put a post up on LinkedIn that started trending in corporate finance and FP&A. And essentially it was around some things that was concerning them within our community. And rather than me explain what those concerns were, because I got a lot of engagement, how about I sort of start by going over to Lance and say, Lance, would you mind maybe sort of sharing with our audience some of the motivations behind the post you put up?
Sure, thanks, Rob, and for joining me and Andrew as well. So, look, this is something which I think Rob and I have been seeing that have been trending over some time, and really this pandemic and the crisis of COVID-19 has really brought this issue to bear. It sort of bubbled up plainly and simply because really in FP&A, we're really getting off track with predictions and data and analytics and that's useful. But right now, we really don't know how to forecast and model correctly. So, you know, we've lost the fundamentals of three-way modeling, of how to do this. And sadly, a lot of us are going back to Excel. So, Andrew, remember we did that podcast, Excel's not dead? Well, yeah. This is proving it. This is proving the fact that I've been going on for a long, long time around these big systems, these expensive systems. I've been on a call recently and a number of people are struggling because their systems, their planning systems don't do what they need to do. And that's model cash flow and navigate this uncertainty, understand scenarios, and get back to basics, get back to the basics of how do you actually do financial modeling? How do you do decision making? Very much from a corporate finance and cash flow perspective. I mean, you've been in private equity, Andrew. Obviously, Rob, long-time corporate finance expert, and I had a stint in investment banking as well. But I've come back into finance, and I think I've always been a big advocate for financial modeling. If there's one thing that it's clear on LinkedIn, I'm quite strong in that domain. And yes, I do like data and data analytics, but not right now, right? It's not the right time for that. Right now, it's actually about navigating this uncertainty we have because there's too many variables. We don't even have the right data to navigate. Historic data is largely useless. We're going in uncharted territory here, and that means modeling. And that means, playing with scenarios, playing with decisions. And if you're not sure, running simulations. Most finance professionals don't even know what a Monte Carlo simulation is. It doesn't mean you need to jump into it right now, but let's start with scenarios. Let's start with sensitivities. Everyone does forecasting. Tick. Yeah, everyone can do forecasting. Forecasting is just last year plus a percentage, right? No, it's not good enough. It's clearly not good enough in this crisis. And so I just saw more and more of this, how would I say, mismarketing, misinformation about the latest in AI and all these great systems that are going to do all your job for you when, I wonder how well those systems are being used today. If there's one thing that people need to take away from this discussion is have a look at what you do tomorrow or the next day or the next week. What system are you using the most? And if it's not Excel, great for you. I'd love to hear from listeners that are not stuck in Excel modeling and playing with scenarios and being dynamic, because that's the problem. So we need to get on board with using the fundamentals and applying it with a tool that's been around for a very long time and being used heavily in investment banking and corporate finance and still will. Banks and IPOs and project finance are not moving away from Excel. No one's building a predictive model for a toll road or a bridge or a building or an IPO for that matter.
Yeah.
Anyway, that's my rant. I'll probably give you guys a chance.
No, yeah, I was just thinking that was I suppose look, a rant would be pretty unkind to yourself, Lance, but there was a lot in there. But Rob, similarly for yourself, like why now should we be engaging and accelerating this conversation?
Actually, Andrew, Lance, thanks both. Thanks for having me. And now more than ever, we got to make sure that FP&A has its house in orders, and that starts with the absolute fundamentals. There's a lot going on right now in our field, and it's kind of exciting. But we are at a moment of outside macroeconomic stress, and we have internal stress as well. And this is the result of new expectations that have been put upon FP&A, and also the collaborative and more integrated approach that our functional area was trying to take with other functional areas. But to withstand all these different pressures coming from both inside the organization and from without, we need to make sure that our foundation is strong. And that foundation is fundamental financial theory and concepts and modeling, which is structured, flexible, transparent.
And I suppose it's interesting you've gone back to these fundamentals, because in this day and age with technology and all these sort of cool buzzwords out there, I guess there's a lot of people chasing the shiny objects and wanting to get involved in the new stuff, right?
Exactly.
They've just done their certifications, whatever institute they're part of, and done their training and whatever, maybe even out of college. So probably this is the last thing they want to be hearing. But so why should they be taking it forward, Rob?
What's going to get you through the last 5 minutes of your football game? Your core strengths.
Core strengths.
And you're going to focus back to the basics. And that's pretty much where we are. We're really, I don't believe, at a point where we can start bringing in flashy new concepts, lose transparency in our work, and somehow attempt to move away from the core fundamental FP&A concepts that have gotten us to 2020. I don't know how better else to say it, except that a return to the core is exactly what's going to allow us to bring on new responsibilities in this uncertain future. Fundamental finance and modeling is our path into the future.
And I suppose
I just want to.
Go on, Lance. Yeah, go on.
Lance.
So I just want to boost what Rob has to say. And when Rob talks about core and the fundamentals, it's all about cash, right? That's the fundamentals. The only reason you go into business and the only reason you get out of business is for cash, right? Everything else in the middle is noise. So we need to really get back to that fundamentals of cash and cash flow. Yes, accounting is important to be compliant, tick, but we need to understand going forward. And going forward is really, no one reports on the accounting. You never report your financial statements on a go forward basis. No one does. Everyone prepares their financial statements, statutory reports on a look back basis, because that's the way the rules are written. Now we have to look forward. And now that's not new, right? We've always been talking about looking forward. But what difference does that make now? Well, looking forward on a P&L basis is useless. Looking forward on a cash only basis is useless. You've really got to look at cash and your balance sheet and your P&L. So you've got to get these in sync. And that's, I guess, to Rob's point, the core fundamentals of finance and corporate finance. Because you go into any investment bank and you go to any transaction that they're doing, and there is a three-way model. You just don't sign deals without that core fundamentals of modeling and decision-making that based on drivers, not based on growth rates. These are not new concepts. And that's one of the reasons why we really trying to create this dictionary, because we feel that these concepts, which have been around for decades, and we're even bringing academia into the conversation with Professor Paul Dunbar, who's also a guest mentor on your show a while back. Fortunately, he's a neighbor for me down the road. But ultimately, he's been reaching out to me actually for quite a long time, saying, what are these people talking about? What are we talking about? Zero-based FP&A. What are we talking about? All these concepts that, why are we reinventing new things that really there is no need to create this new language. We've got a language. We've forgotten it, and we've forgotten how to communicate with each other.
That's very well said, Lance. Andrew, can I jump in here? Just to get it out of the way, really big companies can't zero-based budget, because when you have $15 or $20 billion on the balance sheet, you're not going to start from scratch. To pretend that history doesn't have something to tell you only gets us in the trouble. over and over again. But getting back to cash, Lance, you bring up a really good point. And evaluation at the end of the day is actually very simple. We buy something for cash. We may or may not receive a dividend, and we sell it for cash. It's that simple. The hard part to this is we're going through accounting. If you really want to look at a conceptually difficult and theoretical concept, look at net income, not cash. So cash flow in three-way modeling, while tricky and difficult to learn in the beginning, is truly a back-to-basics approach in corporate finance and FP&A. And that's where we believe the focus should be, especially in times of difficulty and uncertainty.
I actually no. I think it is interesting because my personal take on it is we might have lost the run of ourselves a bit. I mean, if we think back to the blow-ups, the WorldComs, the Enrons, they were busy chasing earnings per share, this net income idea, when fundamentally valuation and value creation and capture is all about cash. It starts and ends with cash. That's not my expression. I think one of you said that to me. It starts and ends with cash. So, like that makes sense to me. So we seem to have lost our way a bit. What things can we start to do to start? I think a dictionary was mentioned. What things can we start to do to anchor ourselves, so to say, to going back to basics?
Lance?
I think the key thing of going back to basics is to Rob's point, and I'll go on about it all the time, is learn the fundamentals of three-way modeling. And the hard bit of three-way modeling is the balance sheet. It is the accounting, but that's the rules we've got, and that's how we report. So the accounting is not useless. It's just overly complex to a concept that is actually quite basic. You speak to anyone around how much cash do you have, and they know how much cash they have in their wallet, in their back pocket, and on their credit card, pretty quickly. And we manage our own lives daily with cash. Although sometimes, on credit cards, it's not necessarily hard cash, but yet when we manage our accounting function and our businesses, we look at profit. How many people look at profit in the context of their own personal wealth? No one does. No one works out, this is my income every year. How much profit did I make as a family? I mean, how many people do you know? I certainly don't. I don't know of any people that look at themselves, their own financial position as a profit.
Yeah,
or loss.
Lads, I actually, lads, I'm going to come in there. I actually met one person about 20 or maybe 18 years ago who actually did that. They actually valued their family.
There's got to be one. There's got to be one.
They did a balance sheet up, and you won't be surprised. Is a long-term chartered accountant. But he did. He's the only person I met that's actually done that. He did an income statement, a balance sheet.
Balance sheet I can agree with. Balance sheet I can agree with because you want to see how much leverage you've got. You've got your house. You want to, when you're trying to get a mortgage. Balance sheet I get. I get putting your own personal balance sheet together 100%. Putting your own personal P&L together, what does that mean? Who are you paying tax to? Why are you doing it? No one cares. Why? Because balance sheet and cash are the most important things. P&L is just vanity and sanity, right? It's not king.
And Andrew, so we have a couple great areas that we can go back to basics with. We mentioned the three-way modeling. We mentioned the intense focus on cash flow, not book values, and not purely an income statement allocated approach. And we've talked quite a bit about language.
Yes.
And this to me is critically important that we get the terminology correct and that we're all speaking in sync, especially in an environment where we have other functional areas coming into the fold, such as accounting, such as IT and statistics. I think if we focus on those three elements, the modeling, the cash flow, and the terminology, FP&A will come through current circumstances just fine. But we have to go back to the basics in many regards.
So maybe they're the, it's not just one anchor. Maybe they're the three anchors. And I do want to get you to share one of your sort of anecdotes, Rob, with our audience. But before I do that, I think that point you made about terminology and language is quite key. There was a study done by the Australian Financial Review, and it was trying to figure out why so many people avoid talking to, in particular, accountants. People who are fairly familiar with putting up P&Ls together. Even though there was like an 83% chance of a successful outcome of having a conversation with an accountant, only 1 in 10 people sought out an accountant, And I think what most people, when they asked why that was because they were frightened of being bombarded with all these complex terminology and being, talking in a completely different language to what really needed to happen. So I think there's a great opportunity for FP&A professionals in particular to maybe sail into or make the most of this opportunity to develop a common language, be able to talk with the business with what they needed, And I think, to lead into it, then you have a fantastic story, I think, about some sailors and where they developed a common language.
Yes, Andrew. A few thousand years ago in the Mediterranean, the known world, quote unquote, at the time, sailors were coming from all over different, countries and city-states, and they were meeting at sea, and they didn't know friend or foe, and no one spoke a common language. It was truly the Tower of Babel. So what the sailors did is develop their own at-sea common language amongst themselves. And we see that today in corporate finance and accounting, such as EBITDA. Now, EBITDA is a very flawed concept in many ways. The term was developed in the 1980s. It may have been John Malone, telecommunications, private equity buyout guy. EBITDA doesn't really tell us very much, and it's not either, it doesn't belong on an income statement, and it's certainly not cash flow. But nonetheless, EBITDA is a common language. It's a common language among investment bankers, in-house accounting and finance. And that's one example of where we can all come to terms on common ground and communicate effectively, bottom line.
Yeah. What do you think, Lance? This idea of having a common language, even a dictionary,
You know what? I've never thought about EBITDA being exactly that, and that's a great example because I don't think there is another metric that is got that unification across functional areas. Across, not long ago I went to a second-tier accounting firm that does valuations. And I challenged the person. I said, look, are we ever going to get rid of this EBITDA concept for valuation? Why is it an EBITDA multiple? I said, why? Like, it's not. It's back of the envelope stuff. It's sort of 5 times, 10 times, 12 times. That's the value of my company. Work done. I said it's dangerous. I said it's DCF is true value because you can actually look at the proper cash flows. And he says, you're right. He says, you're right. But unfortunately, it's been around for so long and everyone uses it and it's still the proxy and it's still in some cases useful. And I agree, it is useful as a proxy, but in of itself, it's dangerous. That's why you always do multiple valuation metrics to work out, dividend yield and all different ranges of, comparables and PE multiples as well. There's a range of different, and price to book, revenue multiples, God forbid, let's not go there again. There's all these spurious. I mean, I was a CFO for a fintech not too long ago, and we had one of the most ridiculous metrics, and the only reason we had it was because the rest of the fintech sector, largely out of the US, was using the same metric. So we thought, well, let's value the business on that same one. Cumulative loans written multiple. And I'm like, hang on,
Is that all through history?
Profit. That's not even revenue. That's like volume. And so you can write shitty loans and still get valued at such a high price, purely based on an activity which is purely vanity, pure vanity.
Yeah.
That's interesting, Lance. Putting that in today's context, the U.S. media is still completely fixated on accumulated COVID cases. But we're coming down the back of the curve, and we really care about net. But the media doesn't. The media is all about accumulation. So
well, it's that's a really good point, Rob. I mean, for me, the big one is how many people have recovered, from it. Despite the cases, despite the deaths, which are horrible and awful,
right.
How many people recovered? And if you looked at deaths down in particular sectors, like they were the hotspots that we didn't protect enough in society, the care homes, the healthcare workers, so it's just interesting. Again, I think we were probably measuring the wrong things, and EBITDA could be just one of those. It's a vanity metric, the old EBITDA.
We can use EBITDA, and EBITDA is very helpful if we understand that it is not always a great answer, and it is not to take the place of disciplined net cash flow approaches. And this is where FP&A really needs to hold the fort down. And this is a big concern of mine. As new languages and as we adopt the terminology or are influenced by the terminology of other functional areas, it's our job as FP&A and corporate finance professionals to hold the fort down. If you asked a judge, an accountant, and a corporate finance professional the definition of fair value, plus those guys on TV, is it, I don't know, Squawk Box or whatever. If you ask them the definition of fair value, you would get 3 different answers. Someone has to take the reins to make sure that we are making decisions in a disciplined, quantifiable manner within the boundaries of corporate finance, and that's FP&A. So my proposal is a little less talk about AI and machine learning and a little more talk about net cash flow and market values. I know it's a tall order to some, but at the end of the day, we're only making things easier and more valuable.
I love the way you broke that down, Rob.
Yeah, and look, not to say that we shouldn't eventually get back to AI and analytics and all the rest, but not right now. It's
right.
Not the right time.
Exactly.
Not the right time for it. And so I think, I'm not going to sit here knowing, and people know me, I'm a heavy supporter of technology and use a lot of it, but I'm also, see technology as an enabler primarily. And I think anything that's not focused on those fundamentals is actually a disabler. It's destructive because we're losing the concept of actually getting ourselves out of the crisis, which is purely focused on cash.
So Lance, I suppose in my sort of spiky, robust way, I was involved in a conversation with some finance leaders, and they were trying to figure out how they could use automation and some artificial intelligence, robotics to get some hours back for their finance team. I think that's a big theme at the moment. It's how can we get a load of hours back? I think they were setting a target of 20,000 hours, and they got to 10. And I was saying, okay, so what's the impact on your cash flow doing that? Nothing. They hadn't done any benefits case that these hours back would be reinvested in higher value work. And I said, I can reduce your hourly cost or free up even more time by maybe suggesting that you locate your higher expensed employees in say, I don't know, the US, some expensive European countries and so on, into lower cost or better cost locations, and those people there probably would work, no offense, it's harder, right? And you get your more productivity that way. And then once you've done that, then you can go do the artificial intelligence, the robotics and so on, because you've got a much lower cost base and you've reduced your cash profile. So that cash mindset was coming in. And I'm just wondering, I was a bit concerned that finance professionals are being led by these shiny objects, I call them, rather than getting back to the cash conversation.
I couldn't agree more, Andrew. And please don't ever get me wrong. We are completely dependent upon systems, and we need to know them.
Yes.
Say it's Hyperion, say it's SAP. They're actually a lot of fun to work with. And quirky, yes, but they're a lot of fun to work with. Like, oh, let's see what what's going to pop in my workbook now. They're a lot of fun, and it is a very disciplined approach to data management, and we need that. And please take it from me. I was the guy who 14, 15 years ago actually walked around corporate accounting, opened up file drawers, took out general ledgers, wrote numbers down, walked back to my office, inputted them into Excel, and from there created a $15 billion balance sheet forecast. I don't want to go back to that again. These database systems and the add-on applications that we have in Excel to access that data is critically important. But this is data management and reporting. It is not corporate finance. And we need to keep that in mind.
Yes. Yes, and I think that could be where some FP&A professionals are being drawn into those sort of shiny object scenarios, and they're just looking at it in the wrong way. I think there's a lot more value to be found going back to basics, back to cash.
You got it.
And back to basic tools as well. I think it's not just about the basic concepts. It's about also just going back to basic systems of Excel. And if you want to go fancy, go Power BI. Go learn. It's. But again, you can't really do a three-way model in Power BI really easily. I use Power BI for visualizing the three-way, which is built in Excel. So, use it for the right purposes. And I remember writing my CA exams and having it all on calculator and pen and paper, and that was how we wrote our exams. And recently, I heard the CA ANZ in Australia, they're doing exams. Fully recorded, and it actually looks at your eyes and records the audio that's around you, and so it's fully remote examinations, and they record your eyes, they record which websites you're going to, you doing it online, so actually you cannot cheat. Now, yes, you might be able to use Excel, but that's fine. That's an acceptable tool. Back when I did my exam, HP 10B was my tool. I didn't have Excel. I had an HP 10B, the financial calculator that I could do a DCF cash flow on my calculator.
Hey, Lance, there's still this
cash flow, negative cash flow, and I pushed a little button called IRR, and hey presto, I had an IRR.
There's some listeners that still have their HPs, and actually, I saw some. When I was in an American office last year, I saw a few people walking around with them as well. They're still there. They're still there.
I still have my HP. I'm not getting rid of it. And I found a tiny little sticker that, Andrew, that says, "What if?" ? And I put that on my HP, because we're, as corporate finance professionals, we're always thinking, what if?
What if? Yeah.
Now, if I could just talk a little bit, the Power BI, all the power tools, fantastic, no doubt about it. But let me give you one observation that I've seen on the internet. I see these great gauges. I see heat maps. Trust me, I've been building my own. It's fun. It's cool. But what does the CFO and the CEO really want to see? Keep your end user in mind. You're going to have variances to budget, variance to prior estimate, and variance to last year. And those better show up. Those core fundamentals, back to basics, better show up in your model output, or you're probably not providing the right information. The CEO at 11 o'clock at night in some hotel room somewhere in the world is not going to be fascinated by a heat map or a gauge that you put together. They're tired. They read nonstop throughout the week. They need information. They need it presented, and they want to know the variances to prior performance or expectation. And you got to give it to them. Simple stuff, and we try to move away from it. All the columns, variance to plan, variance to last year, variance to prior. But that's the core. That is the absolute fundamentals of what we're doing. And it's never going to be replaced with a gauge or a cone or a heat map. That's fundamental information. If you open a 10K or a 10Q, what a company is reporting to the world, you will see a very disciplined approach, not only in the variance analysis, but also in the narrative, how quantifiable data and information is expressed through language. That's not going to change.
Yeah, no, I could completely concur, Rob. I suppose then, in terms of if we were to sort of we've given our audience loads of food for thought to go take away and digest. I guess in terms of wrapping up, would you maybe have any sort of parting thoughts, Lance, in terms of what the next step should be from our audience?
Yes, so we've got. I guess we're collating a dictionary. We're going to do it through an app. The three of us, and thanks again, Andrew, as well, for contributing to the article. And it featured, and we might even do updates. For if we do big updates, and some of these definitions are going to be interesting. It's going to be a journey. Don't know when it's going to end. We're going to start it, and we're going to get through as much as we can, and we're going to have academia in mind, because Professor Paul Thumbar is going to join us. We do need gender diversities who will get some mix in there as well, and ultimately also look at I guess some of these concepts to help people. We're doing this not to grandstand, not for marketing. Really, we just see that we're losing our way, and I think the app will come out. It's similar to the financial modeling knowledge hub that I've been running, but this is purely going to be focused on FP&A, corporate finance, and modeling. And as Rob said, the terminology around modeling and corporate finance, it's really honed in on that, because that's what we need right now in this pandemic. So yeah, please reach out, contribute, and let's see where it takes us.
And I'd like to add, Andrew, that the concept here behind a go-to dictionary terminology for FP&A it's really all about the community and a collaborative effort. It'd be great to have submissions and really a forum for agreed upon use of language and terminology. And let me give you some examples. When I cruise around the internet looking for a definition for a financial term, and a great one is SVA, shareholder value added, which has kind of an equity connotation to it, shareholder. When I cruise around the internet, I either get incorrect answers, or I get incomplete answers, or I get competing answers. Many of the sources that we go to are not in sync and in unison. And this is a chance for us to contribute to the community at large in a wholly collaborative manner. We got to be on the same page, bottom line.
Yeah, I think that's a great way to wrap up, actually, those sort of parting thoughts. And, just to that point, Rob, shareholder value added, that's where, we try and do with Strength in the Numbers, is try and demonstrate the value we're offering in finance. Even my team, we report shareholder value added in terms of the work we do. So it's great to see a community initiative where we come together and can actually build from here, go back to basics and build from the basics to something that's really going to be useful and stand us in good stead into the future. So Rob, Lance, thank you so much for making your time today and investing in Strength in the Numbers and sharing such great insights with our audience. Have a great rest of the day.
Thank you.
Thanks, Andrew.